Welcome to this Brand Bitesize. In this video, we're going to talk about maximum tax-relievable pension contributions. When considering the maximum level of tax-relievable pension contributions, there are two statutory annual limits which need to be considered: the annual allowance and the relevant UK earnings. Let's start with the annual allowance. The annual allowance is the maximum amount that can be paid into a pension each tax year without triggering an annual allowance tax charge. For a defined contribution pension, this includes all gross employer and personal contributions paid into the pension. Where the annual allowance has not been used in full during any of the 3 previous tax years, it can be carried forward and used to increase the current year's allowance. In order to use carry forward, the allowance for the current tax year must first be used in full. Carried forward allowances must be used in order, i.e. the earliest tax year first. After 3 years, any available carry forward will be lost. Let's look at an example. Ben earns £80,000. He and his employer are currently contributing £5,000 gross per annum each. He's just received a large inheritance and wants to use this to maximise his pension contribution. In this example, we will assume Ben is entitled to the standard annual allowance of £60,000 and is not subject to the tapered annual allowance or the money purchase annual allowance, both of which could reduce the available annual allowance. Ben has an unused annual allowance from the previous 3 tax years of £30,000. His total annual allowance is therefore £90,000, which is the current annual allowance of £60,000 plus carry forward of £30,000. His total pension input so far is £10,000, which is £5,000 from Ben and £5,000 from his employer. Therefore, Ben and/or his employer could make additional gross pension contributions of up to £80,000 without incurring an annual allowance tax charge. However, there is also a secondary limit which applies to personal contributions, which is the relevant UK earnings test. This means that the maximum personal pension contributions during any given tax year cannot be more than the total of the member's relevant UK earnings for the year, or £3,600 if lower. Relevant UK earnings generally include employment income or self-employed income, but not property or savings income, dividends or pension income. For example, a person with relevant UK earnings of £40,000 may only contribute £40,000 personally. This cannot be increased by carry forward. Carry forward is solely a mechanism to increase the annual allowance, not the relevant UK earnings. Going back to Ben in our example, his relevant UK earnings are £80,000. Although his available annual allowance is £90,000, the maximum gross personal contributions on which he can obtain tax relief are limited to £80,000. As he has already made a gross personal contribution of £5,000, he can make a further gross personal contribution of up to £75,000 and still receive tax relief. Note that only Ben's personal contributions count towards his earnings limit. Employer contributions are not restricted by the relevant UK earnings test, although they do count towards the annual allowance. Therefore, Ben's maximum additional tax-relievable personal contribution is £75,000 gross. Thanks very much for watching. We'll see you next time.